All right. Happy Monday, everybody. Okay, so we are going to get started in 1 minute. Yeah. Okay. Once we see that the Zoom thing is going here. All right, perfect. Okay, so welcome everybody. It is Monday, March 25th, and we are in the middle of March break in Vancouver, BC. So if you are on March break, I hope you are having a fantastic time. And this will be recorded so that you can watch it after March break. Okay, so I am Hung Lu and I am with Cash Property. And today, in the next 30 minutes, we're going to be answering, we're going to analyze a stock lending as an alternative to diversifying within real estate. So we're not analyzing a real estate deal, but what we're doing is we're going to analyze something that, a lot of investors, when we start doing real estate deals, we're like, oh, okay, well, I need to diversify. And so buying stocks, investing in stocks is one way to diversify. And within investing in stocks, there's this thing called stock lending. Okay, so it's where you lend out the stocks that you have, and we'll get into the calculation of whether or not that makes sense. Okay, now because we're talking about money, I do have to put out a disclaimer there. Okay, that this is really my ideas, and please, before you buy stocks, before you do or don't do stock lending, please go and check with somebody else, make sure that it's right for you. Yeah, the whole thing with diversifying outside of real estate is, it can be debatable because, if you're doing well in real estate and you know what you're doing within real estate, why do you need to diversify? And, the other argument is that within real estate, there's so many strategies. There's so many different programs within real estate that you can diversify within real estate, right? So, for example, if you are doing multifamily, well, you can diversify and go into commercial land, okay, or farming, or some other type of program altogether within real estate. So you still can diversify within real estate without going into stocks or businesses or something like that. So we will get into the stock lending analysis. And then if we have time, I'm going to answer two questions that came in today. Okay. One is a spin-off of, I think this one came in last week as well. And then there was another question about buying a home. Okay. So we will go through that question because I think that one will also warrant a bit of an analysis too. So if those questions only if we have time. Okay, because I don't know how long this stock lending is going to take to do that. All right, so let me get started here. Okay, so welcome everybody. All right, so let me share screen and you should see an Excel sheet. If I can find this Excel sheet. Oh, I've somehow lost my Excel sheet. Or am I already sharing? I don't think I'm already sharing. Hmm. Uh, Layouts. No, I don't want that. Okay, let me try this again. For some reason, it's not giving me the option to share my Excel sheet. Oh, there it is. Sometimes when you're just looking at something, looking for something, and it's right in front of you, and you just don't see it. Okay. All right. So this is a spreadsheet that I put together because in the last couple of years, with interest rates going up, I was like, okay, well, let me start diversifying a little bit into stocks. So I'm not putting new money into stocks. What I'm doing is I'm taking my RSPs and TFSAs and the money that I already have existing there and saying, okay, well, instead of doing private lending or instead of doing some other strategies within real estate, let's put that money towards stocks and see how we can do there. Okay, so because I have this money already buying stocks, an option came up to do stock lending. And I'm like, oh, this is interesting. So part of this calculation is for me to figure out, does it make sense to do stock lending? Okay. So this sheet here that you see here, in the orange, I had four major findings from this. I'll tell you what those findings are, and then I'll show you the back calculations that go into supporting this. Okay. So if you don't know what stock lending is, go and Google it. I'm on, some stock lending platforms, and they have this service, and that so that it's a requirement for them to tell you in plain English what it is, what the risks are of doing stock lending and so forth. Okay, so I pulled this out from the Wealthsimple risk disclosure document because I wanted to know this for myself. Okay, so there's two sort of main risks that I was like, oh, okay, this is definitely something to make sure that I understand. So one is that there's no coverage from the Canadian Investor Protection Fund. So that means if your stock that you lend out doesn't get returned back to you through their program, you have no protection under the Canadian Investors Protection Fund. Okay. And then the other thing too is that if Wealthsimple becomes bankrupt or whatever liquidity or insolvency in their case, then I may not get my stocks back. Okay. So that's money that I've worked for. And I was like, okay, well, I definitely want that money back, even if I don't make any money, right? Like if I break even on it, I still want that original capital. Okay. Okay, so those are the two risk things that was like, oh, okay, I need to make sure I know that. Okay, so the four findings that I got was that regardless of how big your portfolio is, like it doesn't matter how big your RSPs or TFSA or your stock portfolio is, the ROI from stock lending is the same. So this was like, what? Like if I put more money in, shouldn't it be a higher return? No, your return is a percentage, right? So if you are putting 100,000 in versus 500,000, your ROI, your IRR is the same regardless. Okay, so I was like, oh, okay, so then it doesn't really matter. Like it's not like I need to wait to have 500,000 to make this more worthwhile. Okay, the second thing was to make sure I look at ROI. Okay, as opposed to saying, oh, I'm getting a return of 25,000 or I'm getting a return of 500,000. Well, it's relative, right? To make sure that I'm comparing apples to apples, I want to look at the ROI, which is why the first point was like, oh, how come the ROI didn't improve, right? With more money or the higher returns. That's because it doesn't matter. Okay, so that was the second finding. You want to make sure that you're looking at the ROI percentage, not the number of money coming physically back into your account. Okay. The third thing that I found really interesting with my analysis is that the ROI doesn't increase or decrease depending on the number of days that my stocks are loaned out to somebody. And I was like, what? How come? Like, you think that if I lent it out longer, I would make more money, right? So I'll show you what I mean by that. That increasing the days on the loans, it doesn't actually increase my ROI. Like my ROI is my ROI, whether I lend it out on 10 days or 20 days, right? The dollar amount will change, okay, because I'm lending it out for a longer period of time, but the ROI is the same. Okay, so the last findings that I found was that the only way to increase the ROI, okay, so that's this last point down here. The only way to increase the ROI is to either increase your lending rate, okay, and I'll show you what that lending rate is because it's not set by me, it's set by the platform, okay? And the other way to increase the ROI is the split, meaning I get a percentage of whatever the profit is and the platform gets another percentage, right? I don't set that. They set that. Okay, so I'm going to show you that as well. So those are the only two ways that you can increase the ROI. And that ROI, like I said earlier, doesn't increase with my portfolio numbers. It doesn't increase with how long I leave it in there. Okay, those are the only two things that I can control, along with, okay, well, and I can control what stocks I'm buying and which stocks I lend out. Okay, so those are the things that I can control. But the only way to increase the ROI is through the rates and the splits, which I don't have control over. Okay, so let me show you what the, like, we'll go into the calculations now, okay? So let me see here. So here's the calculations. So look at these two sections here. The first section I did when I was trying to figure it out with points. But on Wealth Simple, they use percentages. And so then I was like, okay, so once I figured out the how to calculate it with points, and I'm like, okay, let's go to the percentage calculation. So there's two types of classes for stock lending. One is high demand and one is for low demand. So those are the two. So high and low. Okay. So let's look at the low demand one first, because I think if you understand the low one, then talking about the high demand one will make it a little bit easier. Okay. So if I have a stock, and it doesn't matter what it is, like ABC, right? So this stock is not a high demand stock. So there's not that many people willing to take this stock. So let's just say um, the platform has to pay somebody to take these stocks, okay, which seems like a crazy idea here. Like they're going to pay me to take the stock to go and do something with it. Okay, so that means that they're giving the stock away basically, okay, and they're charging them a negative number, meaning that they're paying them money for the stock. Okay, so I'm not exactly sure how to explain that better, but that's basically my understanding of that. The overnight rate is 5%. So that's set by like the bank. Okay. So let's just say that I have 1,000 of this particular stock and the price of these is 350. Okay. So you can, like the blue cells are the ones that you're adjusting. So you can adjust this as you see fit. So I just put that in there because I wanted to see what the portfolio would look like as I was increasing or decreasing the numbers, right? Okay. So um, 1,000 of these stocks at $350. So my portfolio is $350. So if I'm lending out this whole portfolio and 100% of it gets loaned out for 150 days, okay? So basically like half the year, okay? So the way the calculations work out, so as you can see, like these blue cells are the data that you put in, okay? So the -3 and the 5%, you can just call the platform. So that's what I did. I just called the platform that I'm with and I said, okay, I used their chat GP or whatever, like their chatting platform. And it was really simple. I just said, hey, what's the lending rate on low demand? What's the overnight rate that you guys are using for your calculations, right? These are moving numbers. Like it's not like set in stone. Okay, so then the $1,000 I put in, the 350 and the calendar days is 365. Okay, so that the portfolio is calculated. So based on the -3% and the 5%, the lending return is $19.18 a day. Okay. So when you look at it that way, you're like, okay, well, that's not bad. Like, I'm not doing anything for this money. Like, the stock's already mine. I'm going to get whatever gains are on the stocks. If it's a dividend stock, I'm going to get those dividend stocks too, the dividends from those stocks. So I'm making $19, a day without doing anything. Fantastic. Okay. So, my lunch is covered for today, right? So then you go and you calculate the number, how much is it for the month? Okay, so $575. And then for the year, you're looking at $2,876. Okay, so that's all just calculations. So to get the $19, the way it's calculated is based on the percentages, okay, and then based on how much is in my portfolio and based on how many days it's in there. Okay, so that's just the formula that's in there. And then here's where that $19.18 gets split up because now the platform that I'm using, which is Wealthsimple, they take 90% of that profit. Okay. They get to keep 90% of it. So it's a 90-10 split here. So that means I get 10%. Okay. So that means at the end of the day, I get $1.92. So basically, like, how much is it for a coffee at Tim's now? Like, I think it's that much, right? So that means at the end of the year for for the days on loan. So if this is for 150 days, I'm making $287. Okay. So at that point, I'm still like, okay, well, it's not bad. A couple of, snowboarding trips maybe, right? Okay, but now here's the interesting thing. When I calculate my ROI, this is where it was like, what? Like, this is so not worth my time. Okay, so when I calculate it by month, okay, it's basically just taking my portfolio, the amount of profit I would see, which is $57, right? Because I'm only getting 10%. Take that number, divide it by my entire portfolio amount for that stock that is being lent out. Okay, that is less than 1%. Like it's 0.01. Okay, like it is so tiny. Okay, so now it's only per month. Okay, so now you might be like, oh, okay, well, it's only per month, Hong. What is it for the year? Okay, so for the year, it's 0.197%. Okay, so you just take the ROI by month times it by 12. Okay, so it's 0.2% return on my stocks that I'm lending out. Okay, like it's not even worth the time to take that risk of potentially not getting those stocks back. Okay, so like this portfolio is $350,000, and basically I'm going to risk that for 0.2%. Okay, so let's just say, like, okay, so when I was messing around with this, I had this at $50 for the stock, right? Because I wanted to see what would happen with the numbers. Okay, so as you can see, if I decrease my stocks to 50, my portfolio goes down to 50,000. Okay, but look, my ROI hasn't changed. So it doesn't matter how big my portfolio is. Like, it's not like I'm going to make more money with a bigger portfolio in this case. No, I'm actually still making the same return. Okay, dollar value, yeah, I would see more with the bigger portfolio, but the ROI is what's more important at the end of the day. Okay, so now let's go into the situation with high demand stocks. Okay, so when I was playing this out, I was like, why would anybody ever do this, right? And I was like, okay, well, Hong, not everybody's going to be sitting down and calculating this out. Okay, so that's why I'm like, oh, I got to share this with anybody who would listen. Okay, so the next thing to look at is the high demand stocks. So the high demand stocks are the ones that whoever's borrowing it is going to want it. Like they want this stock so that they can do their options or do whatever they need to do with it. Okay. So options is not the only thing that they can do with the stocks, but it's high demand. And so because it's high demand, the split on this is not 90-10 anymore. It's a 50-50 split. Okay. And so I was like, okay, well, then maybe I should see which of my stocks are high demand, and then maybe it makes more sense on the high demand one because it's a 50-50 split. Okay. So now in this case, let's just say, okay, so I'm just going to go back and put in the numbers that we had here so that you can see a comparison. Okay, so I'm going to go to 150 days and the price is 350. Okay, so we're back to the 350 number again. Okay, so for high demand lending stocks, they don't do like a negative number to the borrower. They actually say, okay, borrower, you need to give us 8% on these stocks. Okay, so it's almost like private lending. Like private lending in first position is, around 8, 9, 10%. Okay, depends on the risk. Okay, so everything in the blue cell is what we enter. So it's 150 days of stock lending with this particular stock. We're going to get 8%. Now, this is set by the platform. I don't set that. Okay, the quantity is 1,000, 350 each stock, and the calendar year is 365. So we're going to lend it out for 150 days. Okay, so the portfolio is 350. That's a calculation. So the lending return per day, it's the same formula as it was on the low demand stocks. So the result is $76.71 per day. Okay, so a significantly higher return because now we're seeing an 8% return on that money or that stock that's gone out. Okay. So then for the month, it's 2,300, which is awesome, right? Like that's enough to pay rent, right? For some people. Okay. So the lending return is 11,500 for the duration of the loan on the number of days that the stock is out on loan. Okay, so 11,000, that's a lot of money. Okay, so I was like, wow, okay, this seems more interesting. So the split is 50-50. I don't set that. They set that. They tell me, okay, Hung, if you want to put your stocks up for lending, we'll give you 50% of whatever the profit is from the 8%. Okay, great. So then I go into the calculation and I say, okay, well, my split is going to be 50%. So each day I get about $38.36. Okay, so that's not bad. You know, now I'm covering a dinner as opposed to like a coffee at Timmy's. Okay, and then the month per month is 1,100, and then for the number of days of that it's been out, it's 5,700. Okay, so it's not a bad return. Okay, but now of course I want to know what the ROI is. Okay, because that's the 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 measuring stick. Okay, of whether or not this is a good option. Okay, so per month. Okay, so I'm just going to just go to the per year number. So per year ROI is 3.945%. Okay, so just around 4%. Okay, not that much significant, like, yes, it's higher than the low demand stocks, but it's not higher than what you could get in a GIC. It's not higher, than what you can get with some other alternatives. Okay. And so I was like, okay, so for 4%, does it make sense to put my $350,000 portfolio potentially at risk for 4%? Okay. And so I was playing around with the numbers here saying, okay, well, what if it was only 50,000, right? 50,000 portfolio, would my ROI be less or more? Well, look, my ROI is the same. It doesn't change, right? So this was a real eye opener for me that, okay, like the dollar amount in your portfolio doesn't matter in terms of the returns on the stock lending, right? So when you look at this, it's like, why would you put any amount of your stocks up for like a 4% return, right? Especially when right now inflation is high, like it just doesn't make sense. Okay, so this here is yeah, those things that I found out earlier. Okay, so that is what I have on stock lending. So as you can imagine with this finding, I did not proceed with stock lending. Okay, so I would love to hear any feedback on this. Okay, this is something that I do, because it's what I do. So, but it may not be the all-encompassing mind thought on this, because obviously there is a benefit of doing this, because otherwise these platforms wouldn't offer it. Okay, so there are people lending and borrowing stocks. So if you have, yeah, I would appreciate any feedback or comments that of stuff that I've missed potentially in my analysis. Okay. All right, good. So we have a couple of minutes before we go. So let me go into the two questions that we got. And you know what? I'm going to answer one of the questions today. The other one I will hold off until next week, and I will prepare a calculation sheet for us and we'll walk through that one together. So the one that I'll put off till next week is about buying a home now in today's market as opposed to continuing to rent. Okay, so the question is, should I buy something now, even with the insane rates, or should I just keep renting? Okay, so I will leave that for next week. So the one that I will go back to answering is, what do I do if I have no money, no education, and no family support? Okay, that is a tough situation to be in. Okay, so I answered this last week with some sort of general comments, But then I was thinking about it again, and I want to add on three additional comments that I didn't put in the last time that as I was, sitting on this throughout the week. Okay, the first one is that regardless of what situation you're in, okay, with no education, no money, and no family support, those are three things that if you had one of those three or two of those three or all three, your situation would be very, very different, obviously. Okay, so here's the first comment. Look at what you can control and what you cannot control. Okay, the stuff that you can't control, not having no money, no education, no family support. Okay, well, you can't really control that. Okay, but and you can't control the mortgage rates. You can't control the regulations. You can't control the underwriting that the lenders do. Okay, so those are things you cannot control. Okay, but here's what you can control. You can control getting more money. You can control going to get an education. Okay, you can control being around like-minded individuals. Okay, yeah, you may not have the family support, but you can go get friends. You can go and join a network that of people who will support you in your endeavors here. Okay, you don't have the money. Okay, well, go and get a job, especially making that job align with something in real estate. Okay, so if you are handy, if you want to learn how to do construction, go into construction. Get a job working with a contractor. Okay, if you're not handy and you're more maybe into numbers, maybe into books, okay, well then go and work at a real estate office. Okay, real estate offices are always looking for young blood. Seriously. Okay, so there's and I can't remember who this was, but when they were starting out, they just went to their local real estate brokerage office and just said, hey, you know what? I'm thinking about becoming an agent. I would love to work at your office for a month. Okay. And they didn't get paid for it. So you don't have to do it for a month, especially if you need money to live off of. But you can volunteer to work at different agencies and then learn from them while you're working there. Okay. So the education part doesn't need to be like high school or college university book knowledge. It can be street smarts. Okay. So like my education in real estate did not come from a real estate course, right? Like my education is in engineering. Okay. So the thing about no money, that's a tough one to be in because the mindset that a lot of us have is that you need money to make money. Okay. It helps. Okay. If you have money, it's definitely easier to make money. But it's also a lazy way of making money because if you have money, then you don't need to work at figuring out how to make money. Like you just pull your own capital. So it's a funny way to look at it is that if you don't have the money, well then hustle and get out there and figure out how to make money or how to raise capital. Okay. So that's the first comment. Okay. So the second comment is I sort of want to share how I got into real estate because I was 21, 22. I had maybe $10,000 to my name, and that $10,000 wasn't even my money. Okay. And so I was in second year university. So I technically didn't even have an education yet. I had no money because all I had was 10,000. And some of you might be like, well, 10,000 is a lot of money. Well, here's the thing. You can save $10,000 in a year. Okay. And if you don't know how to save $10,000 in a year, reach out to me on my QR code and I'll show you how to make $10,000 in a year. Okay. So what I did was I just took that $10,000 and I listened to somebody who said, Huong, you can use that as the down payment on a house. So my first house was purchased with $10,000. Yeah, there's so many like side conversations with that, but buying that house has allowed me to like way more than 3x it, right? As you can imagine with the way appreciation has been. And I've been in this now for 25 plus years. And so the cycles, like I've been through multiple cycles now in the real estate market. Okay. So use my situation as a way to be like, okay, what can I take out of Huong's situation and make it work for me. Okay, like, yeah, so because all of our situations are slightly different, but here's the thing. I was 21, 22. I didn't have a formal education yet at that point. I only had 10,000 bucks to my name. Like I was working 4 part-time jobs. Okay. So, and at that point I was complete, like I had been living on my own since I was 16. So talk about having no family support at all. Okay. Um, so from my biological family. Okay. So those are three big things. Now, one of the great things that I'll mention that though on top of that, no money, no education, and no family support, was that at the time that I had an opportunity come up, I had $10,000 to my name. Okay. And the second great thing about the situation that I was in was that even though I didn't have biological family support, I had an extended family support, meaning people who took me in and gave me guidance in terms of how to live my life, the education, and just the emotional support. So, when we talk about family support, it doesn't need to be biological. Okay. And I was very fortunate that I connected with a family entity that was built up by non-biological people within that entity. Okay, which I'm super grateful for because I wouldn't be here today without the support from this external family. So, okay, so my third point. Um, okay, so which points out to, when I had the $10,000 and the opportunity presented itself. Well, here's the thing. Take the time now when you don't have education, money, or whatever, learn as much as you can. Be prepared. Okay. Because when the opportunity comes, then you'll be ready. You'll be able to take advantage of that opportunity. A lot of times people say to me, Hong, you're so lucky. Oh my God, you got that place for, 20 years ago. Oh, Hong, you're so lucky because you got an engineering degree and you're super smart at math. Okay. No, you know what? Luck didn't really have a lot to do with it. What it was I was prepared to listen to somebody who said, "Hey, Hung, you can take that 10,000 and do this." Okay. I was prepared to use that entire 10,000 and do whatever. I was prepared to go and look at houses for months on end. Okay. Just by accident. Okay. So there's a quote, and I can't remember who said this. Okay. Luck is preparedness meets opportunity. I wish that was my quote, but it's not. Okay. So those are my 3 comments building out on that question about, okay, Hung, what do I do if I have no money, no education, no family support? Okay, hopefully that helps. Please, if there is any more questions that come up around this, please email me and you can get the email from the QR code. Okay, happy to connect and chat about real estate. Okay, that is it for today. Thank you so very much for watching. I love, working with fellow investors, and this is my way of giving back and making sure that we as real estate investors make sound investments to make sure that our portfolio grows. Okay,